My name is Martin. I have been in the incentive world for the last 15 years, and I'm doing that as a member of the EY team, actually, as you will see. And today I think we have a good amount of time to focus on several aspects of incentive schemes, including in the venture and startup world. So I'm happy to share a bit of that, also from the harder technical stuff like the tax and legal topics tonight. And I'm very happy to do that, not alone, but with you from the practical angle as well.
Yes, I'm Melisa. I've been working in and with startups for more than 10 years. I come from Estonia. According to Index Ventures, it's one of the countries where employee stock option plans is most beneficial, not just tax-wise, but also bureaucracy-wise and very, very friendly. So it's kind of an interesting thing that it's not the same way across European Union, right? You would expect that it also creates these opportunities in here. But in addition to us two, we also have US visitors, and we have a couple of additional team members from Ernst & Young and from Salto X. We have Elo, who is my dear colleague, who has been working with these long corridors in Brussels and talked a lot about taxes with very important people and advised them what and how European Union should become better with and understood the difficulties how to make things happen. And then Martin has taken with him Philip as well. So things around employees and how to actually document them is a topic for him, and how to actually make sure that incentives, meaning either stock options or virtual stock options, would be part of that. And they will be part of us as well. We will have an interactive discussion. So yes, we do have slides in the background to support some of the topics that we are talking about. But definitely, if you have an immediate question, then we can try to answer that immediately, and we can keep longer questions to the end as we go forward. When I was at the door and welcoming you to today, I was also asking what do you expect out of today. And a lot of you are expecting information how to really work with your team members, how to set up the plans here in Germany and with the remote teams. Just in case, everything that we say here today is general information. It's not an advice for you to really work according to the specific plans. It's not neither tax or financial advice for you. Disclaimer done. Let's continue. And we cover around like 4 different topics. What we will do today is that I'm a dummy user. Martin is going to be the kind of specialist, and who is going to give more deep information around different details. One thing immediately, whenever me or him say any abbreviations, any kind of terms that don't resonate immediately, please stop us. Let's make sure that we all understand what we're talking about. So we are all on the same line, because this is what it's meant for as well. And whenever you're interested to go into more deep conversations, we can do it during the questions, and we can do it after we're down from the stage as well, and when we continue networking with each other as well. This is my dream, something very simple. Basically, employee stock options, when you're giving them incentives, should be very easy. You start with, let me see. Yeah, it's this side, because it's mirror, right? You should decide that you want to give something for employees. You put the seed down. It starts to grow. You continue with things like being there for enough time, taking care of your seed and seeing it growing. You get into a stage where your part is earned out. So you see your apples over there, and then you buy and sell. Beautiful, simple. And then the issues arise, and founders struggle. So Martin, Founders say that across all the different countries, the stock option plan is broken. And it's not just broken because of the difficult expectations. It's broken for many, many reasons. What is your expectation or experience? What is the main question that a founder with 20, 30 people team comes to you today, and what they should think of for next years to come?
Usually when we or I are approached by founders and the teams, they have the idea of sharing, right, in their mind. So they are ready to give something to their employees. Maybe they also need to, because the employees start asking more and more questions. How can I participate in the company growth? So the simple question they have is, what can I do and what shall I do? So what are the options or the alternatives, maybe I have to say, out there, and what best fits to my situation and my company? And this is, apart from all the regulatory and technical stuff, it's also the main driver of the conversation in the first place. So whatever you do in terms of incentivizing your employees, you need to align that with the company's and your goals and strategy. So we have probably people here that are way better suited to answer that, but I learned once that the three main reward questions are: 1, what do you want your people to do? 2, how do you measure that? And 3, what will happen if they achieve or overachieve or don't achieve it? So also VSOP and ESOPs and share plans and incentive plans, many labels to it, fall into that bucket of it needs to make sense in line with your strategy. So having said that, I have founders and teams approaching us on very different levels. So some have founded a couple of companies, they know have very detailed questions. Others are at the beginning. So it's also kind of part of the educational bit. And then more and more, at the latest during COVID, we get the questions about the remote workers, of course. I mean, it's not too new for us, because we're also taking care of huge companies for many years that have been operating globally in 30, 50, sometimes over 100 countries, and have had questions around incentive schemes globally beforehand. But I think now it kind of flooded mid-markets and the venture scene more and more as well. So I think, given all the talks about remote work, etc., we will have more and more of these questions. And as I said earlier in the smaller group already, I think the pace in which markets develop and talent is actually claiming environments and companies are ready to build it for them is obviously way faster than the regulatory environment is catching up with that. So this is always a balance to say, how can you achieve your modern, fast-paced, highly developed idea based on the current regulatory environment? And of course that is not globally harmonized, unfortunately.
So to add on that, then there are a couple of reasons why people think the incentives don't work. The first is that employees don't understand that. That was a topic that we also covered during the previous event, how to really communicate with the employees. The second part is more complicated. There are issues around different option plans, especially if you go cross-border. And the general idea, as Martin said as well, asked from the team, what is the idea of giving the options in the first place? And one of the arrivals also told me that, how to share success with your team. This is the underlying expectation of options in the first place, to share the future success of your company with your team. And at the same time, there have been cases where, for example, Klarna, that gave RSUs for their employees with a very good belief, ended up in a situation where those employees paid more in taxes than their units are worth later. And even worse, the real cases with real people, these taxes were taken from their salaries. So instead of earning, for example, not high salaries, but even 1,500 euros, half of it was taken in taxes for the company to pay. So the company was good, right? They took care of your taxes, they made sure that you wouldn't fall under not being compliant, they made sure that you wouldn't need to pay afterwards. But still, they took something from the people that they could have earned right now to actually pay their daily expenses. There are issues where startups, companies also have given loans for their employees to buy out, for example, stock options. And again, if this company, for example, is not currently public, if there are no buyers for these stock options, then the employees are just holding the options, and the company that they got it from might actually go down. We have just recently seen, during past 5 days, what might happen with banks, right? So similar things happen with a lot of startups and companies out there at all times. But employees are not, the main reason for employees to get the whatever type of incentives or options is not to be a risk taker, but to be part of something that might grow to become big in the future. And exactly like Martin said, the moment, COVID came a couple of years ago. Before that, everybody were ignoring the fact of being remote teams. Now, it can't be ignored anymore. Probably not even these long corridors there in Brussels, right? And that makes it even more complicated. So you can't really copy the same plans here and there. So again, when I was at the door, then several of you were asking, so how to really set some things up. So let's try to do some more deep legal talk in here as well, right? Ready?
I am,
Set,
yeah,
go.
are you?
So there is very complicated slide there. This is an example of a slide. If you would go and figure out how to start an option plan, here you go. Do all of this that you have here. But please, Martin, help us a little bit down with that slide.
Happy to. Originally, actually, that slide developed and has developed with us putting a couple of the areas and disciplines on a slide that are of relevance when talking about incentive schemes. But it's not too far away from what you are probably used to do in a startup and modern working environment. Basically, you just iterate. It's the same with this topic. You go from the rough idea, broad idea of giving and sharing through available options, detail it down, and then of course, better than not to put it in writing. That is to some extent also legally reasonable for your purposes. So I'm actually seeing that to some extent that we have the IOUs, still the handshake agreements that later on no one recalls. So that's...
What is IOU?
IOU is just, I say, come work for me, and I owe you the options. You will get part of the company. And sometimes the agreements are roughly as is, so not even clear which company, to be honest. So let alone which part, how and when, etc. So of course that is not the norm. The norm is that the system and the ecosystem here is quite developed actually, and the ideas out there are plentiful. This is why, and all the abbreviations, as you said, please jump in if you hear us saying something here. Plenty of fancy words out there. Problem is, everyone understands a bit of a different thing behind it, so it's easy to misunderstand each other. But still, you just dive down from the general idea, available options, I mean, your jurisdiction, your legal form, your size, your ambition, all these are areas that determine it, and we had it last time. What are grant sizes, how many employees, maybe service providers do you have, what is your structure and idea. You can kind of boil down what's reasonable. Question I always get is, what are others doing? What's market practice? What are my people expecting maybe? Whom do I compete with? What are others offering? Which is of course also a very important market aspect. And then you boil it down. Usually there's some kind of a term sheet which sounds fancy, but it's just all these criteria written down, right? Which is easier than to start writing down a legal contract from the outset if you have just your idea in mind and try to write that down into paragraphs straight away, because usually you also have some discussions with, at least among shareholders, maybe the company's board, to decide whether that bad lever shall include the people that resign themselves, or if you keep them as a good lever. But I think we covered a lot of that last time. So you end up at step 3 here, the legal papering of it, and ideally along the way you have in mind all the different aspects that I outlined below. Accounting is usually very late, legal apparently early, also tax, you should think about it, even though it may and usually does kick in at a later point, and the cross-border and valuation topics, we can come to that in a bit. So maybe I'm curious now, and I'm sure some of you have received an option or award grant without testing you, of course, now, but do you recall or maybe have an idea what the set of documents you received looked like? You recall what's on the first page you received? Just shout out loud. Usually you only have 2 sets of documents, and they aren't too long. They are still in the category of probably Amazon terms and conditions, so I'm sure you recall them well from your last order. Still, usually you have these 2 documents, which is an award letter that says, "Dear," and then your name. Lucky you, you get 375 options, and then blah, 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 another page or so. That's the award letter. And then if you continue to the second document, this is where it says terms and conditions, what is an option, what are levers, what's your vesting schedule, what is actually a triggering event. So what's the paper, when will the paper you got here be worth anything, and how are these defined? And then in the background you need a third document, usually that you see here, which is kind of untechnically the agreement of the people that give away something that they are fine with it, which is the shareholders allowing the company to enter into that obligation to share a bit of the proceeds, depending on, usually it's an exit event. In the venture scene, I have not seen anything else, to be honest. So an exit event is usually sale or going public, IPO, or maybe even a huge capital round can be a triggering event as well sometimes. So that are the 3 documents, and I know it's, for most of us, it's not a huge pleasure to read through them, but actually my experience is you better do once and start asking questions from the outset as well. It usually turns out to be a good idea to be clear in the first place. And I mean, length is also okay. I think the grant letter is usually just 1 to 2 pages, and the terms and conditions are 10 to 15 pages. Still, as I said, appreciate it's not the most interesting lecture, and I still am convinced that most people don't read at least the second set. But I mean, yeah, the tricky bit is you may have a couple of sets saying VSOP or ESOP or incentive scheme. Each one may be different, right? And this is the part of the discussions that we usually have on a term sheet basis. Is the triggering event an IPO on NASDAQ or in Frankfurt, or maybe both, or maybe somewhere else? Or if we just sell the shares to a strategic buyer, what if we sell 50%? What if we sell 51? What if we sell just 30? What if we sell 74? What is the trigger and how do we define it? So we have then the pleasure, if that is unclear sometimes due to fancy deal structures, to figure out, well, is it now triggered or isn't it? And someone wants an opinion, because usually the employees then say, and the beneficiaries, of course it's triggered, fully triggered, but maybe the company and the shareholders have a different idea.
I have a question for you. So if I'm a company, I am the founder and shareholder coming to you and asking for advice, which is not an advice actually, right, in here, but it's just for fake me. That, you know, I would like to get a plan for my team that would kind of protect the company and the shareholders as well. What should be this optimal amount of exit trigger? What would you advise?
Again, typical lawyer's answer, depends, but I will add some numbers in a second. It depends on your strategy, right? What we usually see is it's an IPO on any stock exchange, or it's a sale of more than 50% of shares. These are the usual triggers, or assets, but asset deals have been quite rare actually. But I have also had clients that say, I'm sure we either go bankrupt or I sell 100% of the shares. I don't want any other trigger in there. That's it.
And what it would be the other way around? So I'm these 30 employees now in that company, and I'm coming to you for advice that, you know, Martin, I'm gonna have an option plan with my company, and please advise me, like, what should I ask for that trigger? You know, should it be 0? Should it be, because if the company sells, not the company, the shareholders, right? There is a minor shareholder who will sell, for example, 5% of his, or 5% of the company stocks. And if that doesn't trigger my exit event, then can it be that, you know, they will start to sell 5 and 5 and 5 and 5, and me and my 29 colleagues will never see the money. So what should I do?
You should be careful that the clause has kind of a cumulative view to say, well, either one or a cumulative action of transactions that adds up to these numbers. And usually still as a beneficiary, you are not in a position to negotiate triggering events, but just your stake then in an exit event. Still you need to understand that. And actually a discussion that has been going on, and probably will even more going forward, is how these secondary transactions, maybe even among shareholders, right? Someone says, I want to reduce my position, and another VC is happy to top up his existing ones, or a new one comes in, to also kind of tie the VSOP to these secondary transactions, even if below the threshold. So we have been seeing that in fundraising rounds quite a lot, that you use part of the funds raised to also offer to employees, you can serve, or you can give us like a percentage of your vested awards, and kind of realize along the way, especially as we have seen the route to exit getting rather longer. And again, very important, mental discounting or behavioral finance effect. If you say, well, you will get something in 3 years, probably, or maybe, it feels different, like, well, things change, it will be 5 years, and then 7, and then 10, and then you say, well, who knows, I don't put any value on that anymore, because it's too long in the future.
So the example that you gave, where the funding rounds have been used to actually make sure that your first employees get a possibility for exit, has been done by many startups. Our own colleague Kaisa from Wise has that experience, where she worked towards making sure that the employees who have exercised their options through the funding rounds would be able to actually sell their shares and exit with cash. But that's a very, very employee-friendly program. When we look at the market with Salto X and we ask for the experiences from the people, we see that most of the companies are not that friendly. And the reason is not that they don't want to be. Well, in general, you know, founders, they do care about the people that they hire, whether they are in the same countries or cross-border. But because of the really huge headache that they get when they look at all these documentations and figuring out. Because by the end of the day, the main focus that a company founder, the CEO, the C-level people should do is to make the business work. So how much to really invest your own time and resources into making sure that the incentive programs would work for your employees. If anyway, the startup founder said that 80% of employees don't understand that. So this is also the reasoning probably why it often goes in the background. I heard an interesting thing about Germany that if you give something for your employees, for example, these option plans as well, and even if you say that it will end in 3 years, that was a topic that Philip actually brought out now that he's using his phone. That the employee might expect that this plan will continue after this 3 years. Philip, do you want to talk about that yourself, or?
Yeah, so that's a rather specific legal situation in Germany actually, and the German word for it is called betriebliche Übung. You may heard about it. It's kind of an operational practice that comes into effect when an employee offers a certain benefit for a certain time, a certain point of time, or on a continued basis, right? Like 2 times, 3 times. And then even though the employer may decide, I don't want to grant this benefit anymore to my employees, he raised the expectation in the head of the employees, I will get this benefit in the future. Can you hear me? Yeah, okay. I will get this benefit in the future and also for the continued future. So the employer intended to grant a benefit for, let's say, 3 years, and then he decides, that's too expensive for me, I don't want it anymore. But the employee has the expectation that also in the 4th year he will get the grant. And if the employer isn't really careful in drafting the award documentation, then it actually might be the case that if an employee goes to court and says, yeah, I'm entitled to that benefit, that the judge will say, yeah, you are actually entitled, and the employer has to pay. So that's just one example of legal stipulations that really need to be kept and considered when offering benefits or granting incentive schemes. And of course, this all can be mitigated by carefully drafting the plan terms and drafting the award documentation.
I really like these complicated slides, right? Not because they look nice or anything like that, but exactly about the difficulties that are in the background. So what Philip was talking about is this voluntariness. I'm sorry, I'm not going to pronounce the German word about it, right? And making that happen. But there are also a lot of other things as well. For example, I understand that with full self-employment and with anything like that. So I'm a German company. I want to give this kind of different option things for my people. Some of my people are working as employees. Some of the people are working with a service contract because they have this one-man company. What should I be careful when dealing with these 2 different groups?
You should be careful in not annoying the German social security authorities mainly, because they tend to differentiate what an employee, an employment contract, an employee relationship with an employer looks like, as opposed to a service provider. And we have seen that happening. You start with your few employees, you put in place a plan, you call it employee share plan or incentive plan, and then later on you add that very one person that has the expertise but is just working for you on a kind of case-by-case basis as a service provider. And then you also say, well, I want you in the same boat. let's give you some award in our share plan. But unfortunately, it's called employee share plan. And so you may have put some efforts in putting that service contractor in a position where the German authorities say, well, okay, he's not bound by a boss's instructions. He doesn't need to tell you when he or she is ill. He does not need to apply for vacation, etc. But now suddenly he or she ends up with an employee share plan. So if authorities look at that, they may say, but wait a second, if someone gets an employee share plan, he must be an employee, and you have put that service provider in a position, in a very uncomfortable one, of having that discussion why the relationship is still not the typical employer relationship, but he or she is an independent contractor, not subject to Social Security, but issuing invoices with all the stuff and just having different obligations. And by the way, the company is also uncomfortable because it would have been responsible for submitting, deducting Social Security contributions. And they are, in my experience, Social Security authorities are less pleasant than the tax office. They're very strict and they go back as long as they can and reclaim it. And believe it or not, over the years, plus interest, there can still be significant amounts, even though Social Security is kept and or you may have not had the highest earners in these discussions. So no place that you want to end up in. The solution is simple, don't call it employee share plan, but company share plan, which sounds simple, but actually on my other hobby when taking care about managers in the private equity world, wording has proven to avoid or cause much discussions. Like if you say it's a management incentive plan, it rather sounds like a bonus. If it's a management equity plan, with everything else the same, it sounds more like an equity investment. So you can kind of put the odds on one or the other discussion with carefully choosing some wording.
So words are very important in our life and seems also in contracts as well. We have now a topic about taxes. Before I go with any of that, good, exactly. They are that important as this sound coming from outside. Anybody who has specific questions about taxes, could you raise your hand and ask?
You don't treat virtual stock options the same way that you would treat options that the employee has to exercise, for example, and pay. This has generally been confusing for everybody involved, me, the employees. So it would be good to understand what's better from an operational point of view, but then also from the taxation impact on the employee. Because if I have to pay 1,000 euros to exercise my options and then pay the taxes on the value of the options that are not realized, or I don't have any profit, et cetera, versus paying for paying taxes on the value of the options that I am granted after an event. But then that's apparently amortized over the length of time you've spent as an employee at the company. It's all a lot of words. So
very good question.
Because if I'm an employee, I'm working in a company, I'm not this risk taker as a founder, I'm not playing on a stock market, so I'm not knowing taking these risks. I'm working in a company my ass off 24/7, giving everything that I have, and then suddenly, I'm asked for additional money, but I don't have anything yet, right? I would be completely okay to pay any amount of taxes when I get something. So it's okay to pay something out of that I don't have yet. Now, that's my, this pink dream. And then comes that. So, how do we cover this? So, tax law, shareholders, company, group, company, participant. Before we go with any of that, Then taxes, I think in simplified way, we spoke with Elo before as well, right? You know, there are social taxes, basically wage taxes and anything. So anything that my company pays for me, company pays taxes for. Great, well done. I can go to a doctor, my kids can go to school, you know, it's taken care of. And then the big part is kind of these income taxes or asset taxes as well. You know, anything that I own or gain, I should pay taxes from that side as well. So, Martin, how come then we have all this? You know, I have a company now, I want to set up a plan. I go to my shareholders and I'm like, dear shareholder, let's do a great plan. My shareholders will ask me, wait, Elisa, please tell me and assure me that we don't need to pay taxes. How is it with the VSOP in Germany? Do they need to pay taxes in any stage?
Short answer is no. And the bit longer answer, and in the first step, irrespective of ESOP or VSOP, you know, we tax people are quite simple. We like to think in boxes. You can see plenty of boxes here. You can even put a box on the words on the left-hand side. So the boxes, you may also call them tax subjects. The shareholder has some sort of income and expenses and taxes at some stage. So does the company and the employee. And what you also mentioned, the wage tax is kind of in between because the company does it, but for you. So it's, in simple terms, it's just an advance payment for your income taxes that you will pay on, as you said, the income. And I mean, German tax law is generally based on the principle of the more you earn, the more you pay taxes, right? So aligned with your slide before, if you don't get anything, you should not need to pay taxes, and if you get something, you should. As simple as that. And actually the tagline from the previous slide is true for virtual plans that pay out in cash at some specific points in Germany. So, and this is why the German venture world has so many VSOPs in place, because it exactly solves that problem, or it defers the problem of paying taxes until it is no longer a problem, at least not from a liquidity perspective. So with all the boxes here in mind, maybe we can flip to the lifetime of an incentive plan and then come back to the boxes, because just closing the question for now, the shareholders will ask, well, if I'm giving something away, I'm losing something, so I'm tax-wise, I should get a deduction at some point, right? But what should I deduct it from? My shareholding? It's not shareholding, it's not an income, it's an asset, right? So, and the answer is not as simple, but there are situations where shareholders can deduct that as a cost, but it usually doesn't matter too much, because if structured in a good manner, then also gains from selling shares are only taxed in a limited manner from a shareholder's point of view. So the discussion is more on the company's level and the employee's level, because, and if you have been a award holder and have had a triggering event, you will know that only in Germany half of it will come onto your account eventually. So you will feel the taxes literally. But maybe we can flip to the next side, to the life cycle of an option, which all the stuff we did before, the legal documents, terms and conditions, the idea of who gets how much, putting the right clauses in there to not being forced by law to spoil people for too long with too high amounts if you don't longer want to or can afford to. You're at the very beginning at this stage, which is what in incentive plan terms we call the grant date or the award date. So this is when the plan starts to run. Back at the other end, we have the liquidity event, usually the settlement, the exercise if it's an option. So you need to say, or you can say for an option, now I want to exercise, give me my money or give me my shares. This is actually one of the key differences between what people often call VSOP for virtual stock option or share ownership plan compared to ESOP, which again definitions vary already. Employee share ownership plan, E sometimes also stands for equity, real equity. And if you want to get total confusion, ask ChatGPT what the difference is. But be careful with the answer. I won't release too much here. Luckily for our profession, it doesn't know everything yet.
The new version is coming up.
I know. I'm curious how much it will have learned on that end. And it can tell you something about ESOP as well. But a very important point, tax-wise, legal-wise, and also handling-wise is, have you at any stage of that life cycle involved real shares, real equity, irrespective of the legal form? Have you real shares or not? That triggers quite a few points and questions. Again, cash is easier than shares. You don't need to think of, well, you need to think of where's the cash coming from, but that's usually the easier question than where are the shares coming from, whom can we take it away, or them away, capital increase, legal regulations, does a German GmbH work easier than a Dutch BV or NV, what legal form have I, what will I be moving into, who is acquiring it, or which entity will go public, etc. So cash is usually way easier to handle. Again, one reason for many VSOPs here in Germany. And also tends to trigger less regulatory issues, because you usually have that alignment. Once there is cash, you have taxation, and there is not a mismatch, and that is different. I mean, if you look into the broader world of shares and real shares, usually if there is an offer of shares, you have something called a prospectus, which kind of lists all what you're buying, what's in there, what's not, what's the risk, and what may happen.
How many know what is prospectus? Half knows.
Yeah.
So, 2 more sentences. What is prospectus and why is it so long and difficult to handle?
Prospectus is an information document issued by the issuer, so the company that wants to sell its shares, meant to educate potential buyers of that security to know what they are buying. Right? It's like maybe more illustrative way. It is kind of a pitch deck, although usually not as nice to read and follow. And there are many legal requirements, what should be in there and how detailed, etc. So basically you may compare it with the expose of real estate, right? You have some details on the size, on number of employees, some forecasts, etc. So, and it's publicly available. So I think the latest famous one here was probably Porsche. When they went public, I didn't go through all that, but you can, if you Google it, you can get a feeling of what's needed there. Luckily, for employee participation schemes, there are exceptions to that. So even if you used real equity, you don't need to be afraid of that hundreds of pages to be prepared, because usually there are exceptions, also to quite some extent harmonized in Europe at least, but you must be very careful at which stage you need maybe to document the exception. And sometimes it's just a sentence or two in the communication document that you hand out to your employees anyways, to meet the exceptions.
Can I
Of course.
So I'm trying to figure out, Valerie asked a question. So there are, why should I pay taxes if I don't have anything yet, right? So I'm trying to summarize. Elo wants to say something. Why should I pay taxes if I don't have anything yet?
Yes.
Yes, so from these like long corridors from Brussels comes an answer.
Not on that topic. Yes, I just was listening to you and was thinking that I come from Estonia and taxes there are more simple, I would say, and it doesn't have to be that complicated actually. And what I'm thinking all the time that why countries actually make those rules so complex, because from the tax authorities' point of view, where I have more experience than from private sector, I would say that if you get shares, then the tax authority already sees that you get something valuable, and that's why you need to pay the taxes. But you can also design a tax law that would say that we will wait until you get something that you are able to pay taxes. So this is actually the principle of the ability to pay taxes, which is also very important, that you shouldn't take money where it's no money, but there's just the value that you have created somehow. So in Estonia, we introduced our tax law on stock options about 10 years ago, and we took the best practice of all the countries that we knew at that time. And in our case, the tax point is actually at the end of the process. So yes, you get the option, but you don't pay until you get the money from the sale. There are, of course, conditions, so it's not just like that the government would wait, but it is one of the possible ways, and I see that other countries also go in that way, and countries have made changes in their tax law recently to postpone that point of taxation. Just a comment.
No, very good point, because so does Germany. I'm sure many of you followed the discussion, also driven by the German Startup Association and actually picked up by people like Christian Lindner, who want to make the share plan work better in Germany, but are also keen on learning from practical experience how they should do that. And one of the points is indeed to say we don't equally put a value on shares as on cash. So currently, maybe do that first. Currently, the tax office says if you get 100 in cash or shares worth 100, we don't care, we put tax on it. You get it from your employer, maybe because you just exercise your option that has eventually vested and is exercisable, and you get something that is worth, that we can put a value on, which is why valuation was on the first page, by the way. It's a known sphere in the non-listed environment. What is the value of a share? Let's keep apart that for a second. You have a share or you have 100 cash, same value, same tax consequence for now, which puts you in the position of dry taxes, because it feels very dry to have that paper that says, here is your share. Someone tells you it's worth 100. And next to it, you have the tax bill of, let's say, 50, where the tax office say, great that you got richer, give me my share in it. That's what we call dry taxation, and one of the reasons why real shares are not really en vogue here, or are just issued when you are just switching to a public company and can then sell a part of the shares at least, to raise that money on your individual's level to pay the taxes. Actually, there was one attempt in 2021 in the German Income Tax Act to mitigate the dry taxes. However, the mitigation was actually just a deferral. Unfortunately, not up until the point shares are sold, which is what you said is the solution basically. But and that was what is one trigger that is actually in the law, that is current German income tax law. The other trigger would be 12 years down the road, which is also okay. Usually you used to have some events before. But third is the killer parameter, which is if the employee leaves or terminates the employment relationship. So that triggers the taxes as well, and the taxes will be as dry as the day before or the year before, which is why I'm curious, but I don't know anyone who has implemented it, nor know anyone who knows anyone who implemented it. So, and this is also part of the discussions why this norm should be made better now in the next run, in the next draft bill, which is expected shortly. No one could tell me when exactly, but this is something to keep on the radar, which may make it worth thinking of real shares again.
So while Elo came and talked about VSOP, and let's look at the time as well. We will do maybe 5 max 10 minutes. There are tons of different incentive plans across Europe, and there are many more across the world. We've listed like just few of them behind us and here. RSUs, restricted stock units. That was, for example, what Klarna used. Good intention, ended up employees paying more in taxes than they have the asset in worth. For the reasons of taxes that Elo and Martin just explained, because on the paper it seemed to be worth that much. VSOP, so that's the Germany example. Out of all these talks here today as well, I would say that exactly, you have to consider if you want to give shares for your employees, then take into account there are more tax milestones on the way of becoming a billionaire. And with VSOP, there is one at the end when the cash actually arrives. Though the win-win might be a little bit different, right? You might get more with real shares and less with VSOP. And
maybe
yes?
Just to add on that point, why are real shares so attractive? It's also one of the main aspects is taxes. Apart from the emotional connection that is maybe stronger if you're a real shareholder, taxes, and that is true for most countries. And I know we have someone from Switzerland as well, so there it's probably and the Netherlands, but Switzerland is probably the most illustrative one. You can have shares, can have gains on shares tax-free, and employment income is taxable. In Germany, the discussion is shifted a bit. You can have gains on shares, usually taxed at around 25%, plus all the funny annex taxes, we call solidarity surcharge and church tax, etc. So let's say 25, simplified, and employment income is taxed at 45. So you can save 20 percentage points in taxes, actually even more if you structure it with a holding vehicle, etc. So shares are therefore also interesting to be in. However, they are also riskier, right? As the Klarna example showed, and German tax law, and it actually developed over a couple of case law jurisprudence says if you want to be in capital, you need an investment and you need a risk of loss, which is kind of exactly not the point that you say fits into the typical employee sphere where you work your butt off and want to have a share in the overall success but not act like an investor. And this is kind of balancing the tax angle to it.
So what should I get out of this tax thing now in here? And like, we have different plans, different milestones for taxes. And then now I'm a company in Germany. I have, like before, right? I already have this, 20 people in here, probably have grown a little bit. And I'm gonna hire, a bunch of developers outside of Germany. In Europe, I will keep them here because I still care that they would be time-wise closer to me, right?
And then I see all of this thing. But I have a VSOP in place. Martin, how do I approach that?
Usually you just take your VSOP and grant it to the other guy, no matter which country. If you stop there, that is quite risky. But it's also not impossible that it can work. I just suggest you think of a few aspects around it. If it's a virtual plan, it can be rather relaxed. There might be still some other implications, or actually two angles. One is the more compliance driven. Are you considering the other countries' view on the VSOP or whatever plan you have in place and the timings? Maybe, while Germany says we only tax when there is cash, maybe another country says, well, as long as you, or as soon as you can claim anything under the plan and there is no longer any forfeiture rules, then this is for us a strong enough right to put taxes on it. It's rare, but there are cases like that. So rather the kind of must-knows compliance-driven areas. And on the other hand, what you can see up here, you may even have the chance of benefiting from some of the other countries' favorable tax treatments out there. Often you need to tweak the plan a bit, which puts you into the position actually huge multinationals have until today, because they wonder then how much deviation would we allow to make our Swiss or UK employee happy compared to having a globally uniform plan that works the same before taxes for everyone, but may have different after-tax outcomes. Related to that item, when you go abroad, is actually way earlier than when you feel how the VSOP works or does not work. And maybe one remark on, in any case, if you touch the US or any US taxpayer, please talk to anyone. Before you grant it, that's it mustn't be us. It must just talk to someone who can tell you what to consider there, because that is very, very hard to mitigate or get out of later on. We see that every now and then when we do due diligence on companies and see they just coming out from Germany, they use their plan globally, including the US. Bad idea. What you should do earlier on, in any case, and I may need Philip again for this, is to think of, you hire an employee in, I don't know, do you have employees? Any particular country in mind?
In Europe? Portugal.
Okay, let's say you hire someone in Portugal, completely remote, never seen in person maybe, sits and works in Portugal. Then the first question may arise, well, what kind of contract would you give him? Portuguese, German, European?
Portuguese.
There is no right or wrong answer, I think, to it, but you should be aware that labor law is very employee friendly, so you may end up in a position where the employee can say, yeah, we put something in my contract, but you're the German company, I sit here in Portugal, let's see where I have more days of vacation, and as there are rights that you cannot exclude no matter what you put on paper, he or she can cherry pick the best. So you should be clear on which set applies and which mandatory rules. Next bit is Social Security, very much and taxes as well, by the way, very much focused on also physical presence where the work is rendered. At the same time, you pay out salary and you install a payroll. So do you need to deduct German payroll taxes because the payroll is in Germany? Likely not, right? But do you need documentation to exclude you from the withholding, or does the German payroll actually need to register in Portugal to at least settle the Social Security? And by the way, does your employee know how and when to declare all the income in his or her private tax return? So that is also, many of that can be solved via communication to say, don't you know, we give you your salary, but please be aware you may have tax obligations that come after year end, and hopefully you have some money left when the tax office knocks and wants its share.
Martin, what do you think if the crowd has any questions?
Of course, yeah.
I think it's time for all of us to wrap up.
Yes, please.
Is it possible to exclude people from the option plan?
Yes. But don't do it like that, but have objective criteria, I think is the right word here. It's, I think we have it on one of the slides with the many words on it. Law of equal treatment is the buzzword here. If you just award like 50, 20, 30, and it turns out people doing similar jobs, getting to know someone who gets more or got more, they may claim and successfully claim same job requires same incentive. And everyone differentiates. If you differentiate, have objective criteria to it, and you can exclude people, yes.
Like if you're from the US.
Yes, territory may be one aspect, probably not the only one, but you can, the other way around, you often introduce a share plan also in kind of sequences. Say, we're a German company, we start here, then we expand to Europe or just to Austria, first place, and then to others, and maybe others not. Also possible.
Dealing with real shares, so we will just call it ESOP, what are the tax implications when you are talking about transferable options and non-transferable options? I mean, you have that put in your plan, either one or the other.
German view is once you realize the benefit, you get taxable. So that changed in 2006, where until then there was a difference in transferable or tradable options and non-tradable options. Nowadays, German law says options are taxable at exercise, and then there is case law that says if you crystallize your options some other way. The case was someone put his options into his GmbH, so changing legal owner, that triggers taxes too. So even for tradable options, then you can discuss, do you buy them or do you just get them? Also tradable options are basically taxable upon exercise. Big difference to real shares actually, because if you just give real shares right away, you need to pay the taxes on these shares. Even if you put some restrictions on it, you cannot sell them, you cannot do anything, big shareholders agreement, you need to pay taxes. So this is why we don't see many real shares being awarded. By the way, also Germany has some tax favorable treatments on that. So if you're generous, include everyone in your plan, at least in one of your German entities, all these people may be awarded these 1,440 euros free of taxes if you award real shares. That was the other change in law back in 2021. Usually no one really uses that in the startup world as well, because no real shares and not everyone gets it. Yeah, not sure if we have enough cables.
Just
say and
yeah.
Do you see any implications when it comes to using the services employee of a record? So we have tons of those new platforms, right? Deal.com and so on, where you can basically hire remotely, no matter where you're somewhere in Pakistan, so on and so on. Do you see any implications there?
Yes, we do. So the question was about employer of record and what are the implications. So indeed, that's a nice service that is also quite heavily used by many. The question then usually is who's responsible for the ESOP, because it's not an ongoing like monthly salary that someone is just taking care of. Maybe employer of record doesn't even know that the company granted that after hiring the employer of record. So it should be, and I think there is no black or white answer to that. You should make sure once taxable event on the VSOP crystallizes, if that can be run by the employer of record as well, kind of payroll and withholding wise, etc., or if you need to put in place a different process. And apart from that, I have colleagues that say are a bit critical about the employer of record setup as a whole, because you are in what you would call Arbeitnehmerüberlassung, employee lease. So the question is, does it really hold if you go to the bottom of it? But I know many use it and it works, yeah. So, and me personally, I haven't had the discussions on someone challenging it and breaking it up so far. But yeah, the question is, who has the obligations then, and what is the flow of information?
Many of these plans that we have also on the wall and many other plans across Europe, if there are tax benefits that are connected with these plans by the countries, then often they restrict that this is only meant for employees, which basically means that you should not be able to use them with employee of records, those that work for you through Let's Deal or any other possibilities. And that being said, a lot of the additional plans that don't deal with shares do not make that distinction. That was too hard. So yes, we had a question from the back.
Yeah, for foreign companies, let's say a foreign company, they want to enter the German market, so they set up a subsidiary here in Germany, and they start hiring people, and they want to give them stock options. How do they grant the employees the stock options? Should they directly grant the stock options from the stock option plan abroad, or should they hand out the stock options through the subsidiary in Germany, or should the employees maybe even set up a holding company to get these stock options?
This is what we call a central grant by the foreign parent entity, and that is actually the norm. That is what we most often see. Usually you have that same entity also serving its own employees in the foreign country, and then you just have the same granting entity legally granting to German or whatever other employees. That is the norm. All other possibilities are also viable, but you usually don't want to give out the grantor to someone within the group, to just have the plan centrally. You know all the grants, when they have been made, what conditions, etc. What you need to think of is, at the latest when you settle, you probably involve the local entity, because it will have the payroll obligation. Irrespective of that third party then giving the benefit to the employee, the German entity, and irrespective if it's shares or cash, by the way, the German entity has the payroll obligation at the taxable event. So that is usually handled via just streaming cash then through that entity, so that it can use all the payroll data, account numbers, etc. to use it. And often to think of beforehand is, if you want to arrange for a intercompany agreement, to say we grant it as the parent entity and as we have the plan and the overview anyways, but we are going to charge you, dear German subsidiary, because actually it's benefiting your employees, which would lead best case to the fact, thinking of boxes again, that the German entity can claim a corporate tax deduction, meaning when you award the plan, things go up in value, you end up paying 10 German employees 100, so 1,000, and you route that through the German subsidiary and actually ask the German subsidiary to bear these costs. You know, and then the German subsidiary is poorer, it has 1,000 less, and it can claim that as a tax deduction and reduce its taxable base. Often, I know I'm losing you, and that's okay. In a startup environment, you don't really care often too much about corporate tax, because you're loss making anyways, and the losses will go under in a transaction, so it's not a big deal. But you should think of it, because the value, and having that in a current deal, 25 million in LTIP, it's called there alone. Whether or not you get a 30% tax shield on it is significant, and it's currently dragging that deal for longer. So these topics may get relevant at some point. But short answer, parent company grants.
Okay, but one more thing, the deduction for the subsidiary. How do I get the deduction from the subsidiary if the subsidiary charges the parent company? And I, as a subsidiary, get the deduction?
No, the other way around. So the parent must charge into the subsidiary. So only that entity who has the expense and bears the cost can claim a deduction.
This is the place now, like this was the answer why you have to go to actual legal advisors, right?
But the deduction would be abroad in this case, no? For the parent company.
If you don't, so parent company issues the plan, settles the plan, and has the loss itself. It may claim the deduction for itself, but it's not its employees, so usually risky. German entity cannot claim anything because it's not burdened, right? This is why the foreign entity says, I pay it, but actually I send you, dear German entity, an invoice to reimburse me so that I put on the burden on you, German entity.
So I'm a foreigner, I leave the country, that I would be taxed on the shares that I own. Is that only with actual shares registered at the Handels Register, or is it also including VSOPs? Like, so if I issue VSOP to someone that lives here at the moment, but then they leave, and so their residency isn't in Germany anymore.
So
you're the founder of a company.
Okay.
But I've heard, and I haven't had this verified through the lawyer, but I've read up that if I leave and my residency is not in Germany anymore, that I would have to pay, even though I haven't sold my shares, I still look like the founder of the company. Is that the same also with VSOPs as well? Just, don't want to put our employees in a position to miss it.
Only with real shares. If you move away, there is exit tax on real shares, not on VSOP. But, second sentence, if the VSOP crystallizes, usually the grant to vest period is looked at where the taxable income is allocated. So you may have a tax liability later, but not upon leaving. Depends on the country. We need to more sentences offline.
Tiny question related to this. Can you grant yourself virtual stock options as a founder of a GmbH?
Yes. Yes, but usually you don't, because you want the value in shares, not in virtual.
And how would you continue actually having the voting rights then?
Yeah, you would dilute yourself,
Exactly.
kind of. So
we've talked different topics around like VSOPs and options and incentives and all of those things. What definitely like comes out of our approach in here and in Germany, you have a new law coming out that would definitely benefit employees a little bit more. We're working well for companies that will become the next unicorns. Let's close the topic for today. We're happy to continue discussions, whether like online or here for a few more minutes. Actually, let's be honest, even we need to go because we have to be somewhere at 8. But please do visit our website. Martin and his team, all these guys, and actually there are a bunch of women also working with them, are working with us as well to make a difference and really to build up plans that would take a headache away from teams when their main idea is to really share the future success with the people that they're working with today. Thank you all for coming.